Many people aim for a retirement number saying, hey, if I just save this much and hope it lasts, maybe I'll be okay. But what if that number that you're trying to hit is wrong? And if there's actually a different number, one that changes as you do, and it predicts retirement success with 95% accuracy, and nobody really talks about it. But the ones that do understand it, they spend more, they stress less, they might even sleep better at night. And I call it your magic retirement number. And as cheesy as it sounds, today I'm going to show you how to find it. But before we get there, first I want to look at a number that most people think guarantees a successful retirement, when in reality it tells you almost nothing about how ready you are, and that is going to be your total portfolio balance. Now, we've been taught to obsess over it. Once I hit 2 million or 3 million or 5 million, then I'll be fine. But if that were truly the magic number, why is it that we hear of millionaires who still run out of money? Now, the reality is that your balance tells you what you've saved, but not how far it will take you. That's like bragging about the size of your gas tank without knowing how far you need to drive.
Is it just the angle I'm looking from?
No, sir. We are down there.
Oh, this is amazing. Oh, I never felt so alive.
So I want to start this video by really understanding and framing this concept, because you've probably already started to ask the smarter question, not how much do I have, but how far can this take me, and how do I adjust when things don't go as planned? And that simple shift can give you a ton of confidence, knowing that your retirement doesn't hinge on perfection, it hinges on flexibility. And when you know how to adjust without panicking, you stop guessing and start planning. And that's really what the rest of this video is about, finding that magic number that moves with you as your life happens and having a system that can adjust. But here's where things can get a little bit confusing, and this is the direction where I think a lot of people might think I'm going with this video, and it's actually a tool that most people rely on to tell if they're on track. And many of you have probably seen this because almost every advisor uses it, and it's called a probability of success simulation. Now, it sounds fancy, and to be honest, it can be helpful, but only if you understand what it's actually telling you. So basically, it'll project your portfolio and your spending level over the next 30 years, and maybe yours will spit out an 85% or 90% probability of success. You might be thinking, hey, I'm good, I'm safe. But here's what it doesn't tell you. What does this number actually mean? What happens in the 10% or 15% cases where my plan doesn't succeed? Do I go broke 82? Do I have to sell the house? Do I need to go back to work part-time to cover medical bills? The simulation won't tell you what that actually means. So naturally, I see people start to chase 100% success, and it sounds smart, it feels responsible, but here's the part that doesn't tell the full story. If your plan says you have a 100% chance of success, you're probably not spending enough. Or it could mean delaying that great season of your life where you have the most health, time, and freedom, all because a model told you avoid failure at all costs. And it's actually really interesting because the data shows that using a Monte Carlo model, that so-called perfect spending plan where you're equally likely to overspend or underspend, that's a point with a 50% probability of success. Now that sounds wrong, because in school we would be taught, hey, 50% is a fail if we get to that spending level. But if we want to choose a spending level that balances the risk of overspending and underspending, we would choose the median. That's the point at which you're neutral as to whether you're going to be overspending or underspending. That's not a point where the emergency alarm bells start sounding. And I get it, this sounds really contrary to what a lot of people hear about when it comes to retirement planning. Now, does that mean you should just aim for 50% success, close your eyes, and hope for the best? Of course not. I think that would be reckless. In your life, your retirement plan isn't static. Your success rate will move up and down with markets, inflation, spending, and life itself. And that's not a flaw. That's how it's supposed to work. The reality is, by having a dynamic spending plan that is like a thermostat, where when things get too hot and your success rate drops, you make small adjustments to get it back to baseline. And when things get too cold, you turn up the heat again. Because it's not about having a perfect plan on day one. It's about having a plan that knows what to do when things don't go according to plan. In fact, some of the biggest names in investing are already putting this into practice. Take Vanguard, for example. They created their own version of this strategy, and while it's not perfect, it's a major step forward. So let me show how it works and why it may get you closer to your real magic number than a Monte Carlo projection. And then finally, I'm going to show you a different approach that we use with our clients. So when we're taking a look at Vanguard's Guardrails approach, or their dynamic spending strategy, and I know it's not perfect, it gets a lot closer to that 95% confidence level without rigid rules or wishful thinking. So When we break it down, the way I describe this method is it kind of seats itself right between the dollar plus inflation method, which is basically the 4% rule, and the percentage of portfolio withdrawal rule when it comes to the different spectrum of withdrawals. And what it does, it adjusts the market performance and allows for fluctuations in spending, but aims to smooth things out. All this with a focus on not overspending and underspending. And in short, it can adapt to market circumstances. So let's look at an example, and I will say that I've seen different interpretations of how this actually is calculated. I'm not sure why Vanguard doesn't provide a calculation example, but I'll show you what I understand to be correct after researching. So let's say you have a portfolio balance of $1 million, and the first thing you want to establish are three numbers. Number one, a starting withdrawal rate. We're gonna do something different than 4%. After all, Vanguard says 5% is a realistic withdrawal rate, so we're gonna start with 5%. Of course, you can go lower depending on your tolerance. After all, one of the benefits of using Guardrails is that it should allow you to spend more as long as you're willing to tighten the belt when the portfolio decreases. Number two is a ceiling. This is the max your income will increase in a given year. Vanguard uses a 5% ceiling, so we'll use that. And a floor, we'll use a negative 2.5%. This is the maximum your income will decrease any given year. You get to pick those numbers, but Vanguard uses 5% and negative 2.5% in their study. Okay, so let's figure out the income amount. That 5% on $1 million will result in $50K of income in year one. And for simplicity, say you withdraw that all at once. Then let's say your portfolio of $950K after income goes out earns 10% for the year. Now you have a little over $1 million at year end. We'll use that value multiplied by our withdrawal rate of 5% to get your preliminary income amount for year two, which is $52,250. But we have to confirm that amount to ensure is within your guardrails, and here's what it gets a little bit tricky, so bear with me here, and I'll try to be concise. So we take last year's income of $50K and we multiply that by the rate of inflation. Let's use 3%, which comes out to about $51,500. And then we get our ceiling, we multiply that by 5%, which is $54,075. And with our floor, we reduce that by 2.5% to get $50,212. Now, in this case, our preliminary income of $52,250 is within our range, so that's your income for year two. Hypothetically, that preliminary income was higher than our ceiling, let's say $55,000, we would cap it at $54,075. Same thing if it goes below the floor. If it were $45,000, well, you wouldn't need to reduce your income below the floor of $50,212. If you're really nerdy about withdrawals, may have noticed that the traditional guardrail method is similar to the Guyton-Klinger withdrawal system that was developed in 2006. It's not critical that you understand the finer details, but what is important to understand that there are similar limitations with this method. So while Vanguard's system introduces helpful structure with ceilings, floors, and rules-based adjustments, it still assumes life follows a smooth path. But we both know that's rarely the case. The first thing is that this is not the easiest calculation. Once you get on track, you may be fine, but the primary setback I see is the expectation that withdrawals will be steady over your retirement. We both know for most people, out of the ordinary needs will arise. In some cases, larger expenses will be part of the plan. But common planning scenarios like deferring Social Security in order to maximize the impact may require a higher portfolio withdrawal rate earlier in retirement while you wait. We call this the retirement distribution hatchet. Or perhaps maybe you have a mortgage that's going to be paid off some 5-10 years into retirement, which will further reduce your reliance on the portfolio. These common scenarios can change your withdrawal needs. These are normal, expected parts of retirement, but they're not really well accounted for in this model. And on top of that, the math isn't always simple. It takes some setup, a bit of spreadsheet work to manage well, and that's why I don't see this as essentially the final answer to retirement draws, but it's a great starting point because it moves you away from static assumptions and towards the kind of thinking that will increase your chance of success in retirement. So lastly, let's go through our guardrails. We call them the risk-based guardrails, which is sort of a next evolution of all the different complexities of retirement income that we talked about. And I'm going to walk you through how we use it to help clients find their dynamic number and that adapts to the beautiful messiness of life itself. So I want you to meet John and Mary. They retired early at 60 and they need their money to last. What we can see here is from their $2 million portfolio, they can spend about $10,500 per month. Now, if you're quick with math, you'll figure that is a 6.3% withdrawal rate. Now, that may sound high, but here's why it works. And if we look at the long-term projection of their cash flow, we can see that they're delaying Social Security for another 7 years. So their withdrawals are temporarily higher then drop off once that guaranteed income kicks in. This creates what we call that retirement distribution hatchet, where there's front-loaded spending, this withdrawal pattern that's way more common than you think, and this is exactly why fixed withdrawal rules that ignore other income sources start to break down. You'll also see the guardrails. If their portfolio increases to $2.1 million, they can give themselves a raise of $700 per month. If, however, their portfolio were to decrease to about $1.5 million, this could be due to investment decline plus larger withdrawals, they would need to tighten the belt by about $500 per month until things get better. The great thing about this approach is that you don't really have to guess when to tighten the belt when it comes to rough economic times. These times will happen throughout your retirement, and now you have a plan that will guide you to know when it's getting too risky to spend at your current levels and when to tighten the belt. And this sets a line in the sand that we know now when to actually reduce withdrawals. We're also projecting their cash flows according to the research calls the retirement smile, which you can see right here, and it mimics the common spending patterns of retirees who spend more initially in the go-go years, a little bit less in the slow-go years, and it tends to edge back up during the no-go years as healthcare can get quite expensive. And we have less of a floor before we have to cut spending. And that just means reducing income slightly and sooner. So now your spending plan starts higher, adjusts with your portfolio, and accounts for how life actually unfolds, not how a spreadsheet says it should. Now, what about the downside? Because the risk-based approach tends not to reduce income as much as other methods, like the Guyton-Klinger approach, Vanguard's floor does help, but it's not quite as adaptive in my opinion. According to Kitces, when comparing the risk-based guardrails approach to the Guyton traditional guardrail system, it says, those retiring just before the global financial crisis would have only seen a 3% income reduction from the initial withdrawal rate using risk-based guardrails compared to a 28% for the classic Guyton-Klinger guardrails approach. And those retiring before the stagflation era would have experienced a still very painful, not gonna lie, 32% reduction compared to a 54% reduction for the original approach. And even those reductions could be less if you set up a more conservative initial withdrawal rate, as you'll show you with John and Mary. And I'll post a link to that article that compares the methods, the downsides in the description if you want to take a deeper dive into the research. I want to go back into John and Mary's plan and look at some of the worst markets in history and how a basic 60-40 type portfolio, again, that's not a recommendation, would fare given their withdrawal rate during, for example, the stagflation era. This was a time when not only was the stock market bad, but there was a double whammy of very high inflation, probably one of the worst periods to retire, and ultimately what created the 4% rule. And I strongly suggest not to get too caught up in the numbers that I'm showing you. Remember, the beauty of this is it's uniquely designed based on timing, assets, income needs, longevity, and something very important, tax ramifications. So in their case, their income would have held up well and started to get bumpy early on, but then in the early 1980s, that pressure on the portfolio would have told them to tighten up. We got to tighten the belt here. And you can see down here, these are the actual guardrails in action. And if we go back to the income projection, I'll show you this is on a real basis after inflation. When the thick blue line is above the green line, that means they can actually spend more than what we originally planned. But you don't need to withdraw that. A lot of people, you can just leave that invested or put in the bank account if you don't need the income to minimize reductions later. But this ultimately gives you the confidence to know that we can use the weighty evidence of history to help guide some of our spending decisions. Of course, we don't have a crystal ball, but what we can do is be adaptive and learn from our past. So at the end of the day, your magic number is not a static figure. It's not a single calculation you make once and never touch again. It's a moving target, and that's the point, because your life moves. And when your plan moves with you, that's where the confidence lives. That's where the peace of mind lives. Your magic number is the amount you can reasonably spend right now, knowing that if things change, and let me tell you, they probably will, you know when to adjust. That's not guessing, that's real planning, and that's how you retire with a very high level of confidence. If you want to understand how to invest your money in a way that matches this type of approach, you can check out this video by clicking right here. Once again, this is Matt Calcagno, Certified Financial Planner and Advisor at One Degree Advisors. If you'd like to talk to me or someone on my team about your situation, you can click the link in the description below, and we'd love to chat with you. And thanks for watching, and I'll catch you guys on the next one.